Good afternoon, everyone. Welcome to the New Capital webinar, Bear Market Survival Guide. This is Catherine Barr. I'm the Director of Communications at New Capital, and I will be the host of today's webinar. First off on our agenda, welcome. Once I pass the mic over to Leonard, he's going to do a quick introduction and do a behavior survey. He will be talking to you about bear market facts, history and investments, bear market personal behavior, feelings, and actions. Once he is done with his presentations, we're going to do a quick evaluation survey to see how today's webinar went, the technology and content, and hear back from you on that. And then at the end, we will do a Q&A session to answer any questions that came up during the call. And now, before we get started, I will offer the following disclosure statement. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. I am now going to turn it over to Leonard.
Okay, thank you, Catherine. I hope everybody is doing well today. While I get my slides up, let me just start off by asking, how is the year starting for you? It looks like that's good, so fabulous. And I'm assuming that part of the reason that everybody is feeling so good about the way that the year has begun is that the stock market's up 5% to start the year. There was a lot of, and there still is a lot of concern, but there's a lot of concern at the end of last year, given the very, very difficult performance of the stock market in the fourth quarter. So it was the performance in the fourth quarter that led me to feel like, let's go ahead and do our first webinar of the year on bear markets. Let's take a look at bear markets. What is a bear market? How do we define a bear market? What have we had for bear markets in history? And my feeling is that an informed client is a client who's going to be able to pursue an investment strategy more effectively over the long term. And an uninformed client is more likely to be shaken out of positions and shaken out of long-term investment plans. So I call this thing the Bear Market Survival Guide, and it is a survival guide. I think that as we go through these slides, you're going to get a sense of what it takes to keep perspective about a bear market. And I'm not saying that we're in a bear market right now. Oftentimes, you really don't know if you're in a bear market. We were in a bear market in the fourth quarter, however. We hit a point in the fourth quarter where we were technically in a bear market. Market's come back up since then, stock market has, and so we're sort of out of that bear market right now. But of course, anything can happen, and it could resume in the future. So let's get into bear markets. Here's a history of market ups and downs. What immediately stands out to you when you see this slide? Well, there's a lot of blue and not a lot of red. And obviously the blue are bull markets, expansions. And the red is our downturns. And this stands out. Wow, look at that. Down 83% over a 34-month period. So that was back in the Great Crash, 1929. But since then, in comparison, you can see that we have not had a bear market anywhere like the depth of and the breadth, the length of the bear market, the vicious bear market that took place in 1929, leading into 1932. The most recent one, of course, was the financial crisis right here, and that was a 51% down stock market and lasted 16 months. So again, in comparison, 83% down for the Great Depression, and the stock market crash of 1929 began in October, and a 34-month period. This was a 16-month period, half the duration. And then, of course, we have all these other more minor bear markets. What are we calling a bear market? Well, something that's over a 10% threshold for downturns. So all of these qualify. And then as we look at the upside, what we can see is that bull markets, you can just see this, tend to have greater upside, and they tend to last longer. So this is a huge one here, 815% up, 167 months, and came on the heels of this 1929 crash. And you can see, look at this. This was a 6-month bear market, down 22%, and then whammo, 491%, 116-month expansion, and we get another blow off here, and another strong upturn, and another, and up, and another, and up. And so this pattern has repeated. Now we're somewhere here. This is not giving us the most. This is through December of 2017, so we don't have data here for 2018. We just didn't get it updated, but undoubtedly we get something a little bit here, and then we're right here. But hopefully this first slide puts in perspective for you the performance of the market and how it has performed historically. What I don't want is for clients to hear the word bear market and for that to not mean anything, you know, for it just to be this big blob of free-floating fear that's not put into any kind of context historically in terms of what's gone on previously in the market. Okay, so let's do some definitions here. A bear market, a market decline of greater than 20% from its previous peak and has a duration of greater than 2 months. So for duration, that's a pretty low bar, 2 months, you know, greater than 2 months. And we're in a bear market, and a 20% decline from the previous peak. From a sentiment perspective, waning investor confidence and pessimism. Good news is not good enough to support equity prices. What is the frequency between 1929 and 2017? There have been 20 bear markets that meet this definition. Greater than 20% decline from a previous peak and a duration of greater than 2 months. And the average performance of a bear market is minus 30%. That's on average. So you need to be prepared. If you hold stocks through a bear market, you need to be prepared on average for a 30% drop in the value of your securities. So what does that mean? Let's say you have a 50-50 portfolio, right? And that means that half of your securities are in stocks and the stock market drops 30% over that bear market, then you could expect a minus 15% drop in your total portfolio being contributed to by the stock market. So that would be an average expectation that we would have in going through a bear market. Now, last year, we saw our portfolios with performance anywhere from, say, -4% down to our most aggressive portfolios. There were some clients who had, I'd say, -11%, something like that, right? So we were a long way last year in a 50-50 portfolio from -15%. I will tell you that a firm that we know that is led by, well, I'll just tell you, his name is his public information. His name is Brett Stanley. Brett managed several $billion at AIM, very successful, has a fund that he now manages on his own. He left AIM. His portfolio last year was down -33%. Wow. So the Stanley portfolio definitely in bear market territory. New Capital's not really in bear market territory, ranging from -4% to -11% down last year, where you might see on average a -15% down. Average recovery period, average time to recover from a bear market, about 22 months. And that means to reach the previous peak, 22 months. So if you're looking for a bear market to end and suddenly everything's back to where it was before the bear market started, you shouldn't have that expectation. It's going to take about a year and a half, maybe a little bit more, for portfolios to recover their previous peak. Now, a correction is different. Correction is a decline of 10 to 20% from a previous peak and a duration of less than 2 months. Sentiment, the valuation, and or event driven. So it could be something in particular that's driving the downdraft in the market, not necessarily waning general confidence. So we've seen a number of corrections over the last few years, from Brexit or any number of political crises that have occurred. But those have not been events that have driven us into a bear market. They have driven corrections, but not bear markets. There have been 101 corrections. 101 corrections. So what is that? Over a 70, almost 100-year period. So one correction a year on average is what we can expect. The average performance down -13%. And the average recovery period for a correction is 4 months. All right, so hopefully that helps put these two terms, bear market and correction, into perspective for you. All right, so this is bear markets. This is bear markets and recessions. A lot of people are asking about recession. What about recession? Is a bear market always associated with a recession? And the answer is no. We don't always get a bear market accompanied by recession. And we can see here that there are a number where recession has not occurred. Here is the most recent bear market period. This is last year, September of 2018 to December of 2018, down 20%. So it qualified, right? Qualified as a bear market from September to December of last year. And it was a 3-month bear market so far. We've got a 5% up period right now in January. Could be a reprieve, so it was a fairly short bear market that occurred, and not accompanied by recession. You see that right there, no recession. We had positive growth in the economy, and so no recession. This one, May 11 to October 11, no recession, no recession, no recession. Here and here and here and here and here. So roughly half the time, right, we've gotten a bear market. Well, a little bit less than this. So average number without a recession, 12, and 17 with a recession. right? And what we can see here is that when recession accompanies the bear market, it's a deeper, and this shouldn't surprise anybody, it's a deeper fall in the stock market, minus 42%, versus when we get a bear market that is not coincident with a recession, about minus 29%. And so over to the right here, up here, here is bear markets with no recession. And we can see some dynamics of these particular bear markets where there wasn't a recession over here on the right. So the big takeaway here is that, again, you don't have to have a recession to get a bear market. It's about half the time when we've had bear markets with recessions and half without. And when recession does accompany the bear market, it tends to be more severe by about 10%. But it doesn't mean you can't get a difficult bear market that's occurring even in the absence of recession. There's some other things that could induce it. So these are bear markets where recessions have occurred. Here's the great number one, of course. And this goes back to 1947. So here's the recession of 1949. This is going back to 1947. And what's interesting about this particular slide is over here on the right. You can see that there are three different causes in the macro environment that accompanied these recessions. In this particular case, in 1949, there was no commodity spike, and there was no aggressive Fed. There were extreme valuations that occurred in the recession of 1949. The Great Recession, which occurred most recently, number 11, right here, right, in 2008 and into 2009, was accompanied by a commodity spike and an overly aggressive Fed. Of course, the Fed had to drop interest rates to zero in order to deal with that. So there can be different macro environments that accompany recessions and the related stock market declines that can be causal or contribute to the recession and contribute to the depth of the stock market declines. Now, this slide, to orient you to it, over here below the x-axis, all these red dots, these are intra-year lows for the stock market. So the first data point here is 1980, and in 1980, the way to read this is that the return to the stock market that year was 26% to the positive. You can see it with this gray bar. However, at some point intra-year, at some point during the year, the S&P 500 was down 17%. Look at that. Look at the swing that occurred in 1980 between the positive and the negative. We tend to forget this. Look at this very wide 43% swing between the low point in the S&P 500 in 1980 and the high point. And so what you can see is that all of these red data points here indicate that you should expect the market to have a negative period every single year. If you expect the market to be positive all year long, each year, you have a very unrealistic expectation. And if you come to me and say, well, what am I doing? What have I done to, to your portfolio to cause it to have some negativity in it each year? The answer is, I haven't done anything to it. This is the way that it goes. In 1987, the market had a 34% down point when the stock market fell out of bed on Black Friday in October. and ended the year up 2. All right. Here we are in 2000, right here in 2008. The market is going to have a down period every single year. You got to expect that. In some years, it's going to be a pretty steep downdraft. What can we do? What can we do? Well, if you're not able to accept the possibility of a bear market, and the slides that I've shown you say to you, well, I'm not able to tolerate this short-term volatility. It's too disturbing to me. Either you have to sell your investments, even though over the long term, investing in the stock market has been the single most reliable way, other than starting your own business, to build wealth. There are options. I'm experienced with options. Todd has experience in options. And I asked Todd to put together this slide that said, all right, what if somebody said, well, I want to own insurance on my portfolio? What does that look like? And so I asked Todd to go ahead and price it out. And so let's just say you wanted to insure $1 million and you wanted to insure 20% below where the market is. So you said, I'm willing to incur the first 20% of losses, but after that, I want a floor. You can maybe think about it as a deductible, I guess is some way to think about it. But basically, we're hedging 80% of your portfolio. We're leaving 20% unhedged on $1 million of your portfolio, and we're going to do that through September of 2020. Maybe some of you are concerned about Donald Trump, let's just say, hypothetically. And you said, I want to put in place insurance on the portfolio that's going to get me to at least close to the next US presidential election. I want to insure $1 million, and I'm willing to insure 80% of the portfolio. The total cost for you to do that would be about 3%, $30,000. About 3% of the value of your portfolio is what that would involve. So you can ask yourself, do you want to pay $30,000 to put insurance under your portfolio to, really avoid the possibility of a bear market? And even you're not going to avoid it completely. Remember, you're going to take the first 20% of losses. And so after you pay your $30,000 premium, your portfolio is going to be worth $970,000 off the bat. So ask yourself that. I'd be curious to know the answer from some of you if this is something that you're interested in. Now, what would happen to the results? Well, let's say that the stock market moved up 40% while you were hedged, right? So your 970 would become $1,358,000, basically less the $30,000 that you paid for the protection. Basically, you bought insurance and didn't need it. All right. Now, what if the stock market was up 40% and you had not put on any of the hedge, you hadn't bought the put? Obviously, you'd be up to $1.4 million. You hadn't spent the money to buy the insurance. Now, what if the stock market was down 40% and you had bought the insurance? Well, your net portfolio value would be $788,000. So you'd be down the 20%, right, less some of the premium. And then if you had no hedge and the stock market was down 40%, your $1 million would be $600,000. Okay, so there is a discussion of bear markets, a history of bear markets. What do we do? What's available to us? Obviously, you can sell your securities. And then we have more sophisticated ways of putting in place hedges. I'm not expecting all of you to call me right after this and say, I want to buy protective puts, but I did want to show you that there are tools available to us, you know, in the form of puts that you could purchase for 3% of the value of your portfolio to hedge against the possibility of a deep bear market. Okay. What it means, if you're not willing to engage in buying options and protective puts or selling your investments, it means that you're going to have to manage the bear market through your behavior. There's no other option available to us. If you're not going to hedge and you're not going to sell, then you have to behave. So let's talk about behavior. Some of you have seen this slide. This is a slide I use in investing training that I do with all new clients. Humans are not wired for disciplined investing. In the 1960s, we thought we were. We were under the illusion that we're these perfect, rational, economic calculating machines. And then psychologists started to do experiments in the 1970s. And frankly, investment managers and investment researchers and finance researchers started to do their own research. And what we found out is that humans are not wired for disciplined investing. And we tend to make these mental errors, also known as having cognitive bias. And we tend to say things like, I have a proven system for picking winning managers. Well, all the statistics say nobody has that system. My research confirms this is a great stock to own. I knew this stock was going up. Nobody knows if a stock is going up or down. It's a bad idea. I don't want to sell at a loss. Well, it's a sunk cost. So that's called sunk cost fallacy. Once the loss is there, the loss is there, and there's nothing you can do about it. Trend looks good and should continue. All sorts of trend analysis and studies have been done on trend analysis that show that in efficient markets, nobody knows where the next move of a particular security is going to go, up or down. This one I like a lot. I work in the industry, so I know where it's going. Very often working in the industry, you don't know where it's going. And you have what's called proximity bias. You're so close to the thing that all these biases and opinions that you have and ego things that you have about it can creep in, and you start making investments in a very, very attached and unsound way. Anyway, so what we know now is that humans make lots and lots of mistakes in the investing process. And for many people, this is the way that the process in investing comes to look. They start out and they're optimistic, and the market goes up, and now they're really, really happy and they're elated, and the market starts to go back down, and we get a bear market, and suddenly there's fear, maybe even worse. And what happens? Everybody does what here? They sell, right? And up here, they're doing what? They're buying during elation, right? And then they've lost money, right? They sell out right here, and then the market turns, and the cycle starts again. So we don't want to engage in this cycle. And you know, the chart that I showed you at the very top of the history of the bear markets shows you that we're going to continue to get bear markets, but in comparison to bull markets, bear markets have been much less frequent. And if that holds, then that'll hold. This chart is very important for people to understand and to focus on. So reacting can hurt performance. So this is from 1990 to 2017. So this is over the last, what is that, 27 years? So over the last 27 years, if you had held the S&P 500 over that period of time, you would have experienced a 9.81% return and $13,739 in dollar terminal value from starting at $1,000, growth of $1,000. If you miss the one best day, let's just say it came after a day that you sold. Let's say you panicked and sold on a really bad day in the market, and the next day was the very best day, then your return for the period went from 9.8 to 9.38%, and that's a year. And your $13,739 became $12,313. And so on down the line. If you missed the 5 best single days, your return was 8.2%. 6.18% if you missed the 15 best days. If you missed the 25 best single days, I understand that's, unlikely, but your return dropped to 4.5%, and your total return was 34.55. So clearly the best strategy under all these scenarios was to hold your portfolio, get your 9.8%. This is all the way from 1990 to 2017, several bear markets, corrections, downturns, all sorts of political and government events that have gone on during this period. But if you missed the 25 best single days, your return turned out to be very, very close to cash. All right. So markets have rewarded the kind of discipline that I was just talking about between 1970 and 2017. It's a little 20-year longer period than the one that I put up in the slide that I just did from 1990. So this is now a almost 50-year period. And you see all the headlines that have occurred. This is roughly my lifetime. I was born in 1965. And if you invested $1 way back in 1970 in the, and this is in the MSCI World Index. This is not the S&P 500, so take note. This is in the world. You wound up with $59. So 60x, 59x on your money, despite oil embargoes and 13.5% inflation, invasion of Kuwait, currency crises, war in Iraq, debt crisis, and now old DJT. So markets have rewarded discipline, and we can see the bear markets here too. Look, not trying to sugarcoat it here, right? We can see the bear markets here. This one's pretty deep, in 2008. Look at that. That was a steep drop, but in the span of things, the trend is clearly in one direction. There it is. So I'm not trying to sugarcoat bear markets. They're there, and they have an impact. But this is the big picture. Everybody's seen this. It basically says the same thing as the prior slide, but it says it for a lot longer period, 1926, right? Not 1990, not 1970, 1926 to 2017, and it's very clear. Yes, I see the, especially this one, I see that bear market, the Great Depression, and we see this in the 1970s, and we see those are the three that really stand out. But still, look what you wind up with in stocks versus what you wind up with in cash. Cash doing only $21, a little bit better than inflation. So you have to decide: are you willing to make it through these periods? This is a distribution of returns. So each of these squares is a year, right? And so here, these are different buckets for performance. So these are all the years, this particular column, these are all the years that the market performed minus 40 to minus 50%. 1 year, 1931, the market was down 43%, right? And so this looks kind of like a bell curve, right? What you normally expect are returns, you know, and you can see, well, frankly, the bucket that has the most number of occurrences is a 20 to 30% return, right? This column right here, 20 to 30% is the one that has the most number of occurrences, right? A close second is this column right here, this one. Right behind that is this one. So, you know, this is where you can expect, and then number 4 is this one. So, you know, this is where the most frequent occurrences of returns have come from. But look, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, right? 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 2, and 1. Negative years from 1926 to 2017. So we're going to get some negative years in the market, right? Going to happen. 1 here, 3 here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 20 years. Isn't that interesting? 20 years where the market returned between 20 and 30%. I think this is a fascinating slide. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Oh, I can just take 20 and subtract 3 from it, and that would be a lot easier. But I like to make you all listen to me count. Obviously, this one is 16, right? So anyway, I hope this slide gives everybody an idea of what you can expect, because your expectations are very important in holding investments. Do you hold realistic expectations for markets and market performance over a long period of time? Look at this stock. Look at this slide. Stocks on the brain. Stock picking and bear markets. So what I get a lot when markets turn down is, well, your diversification doesn't work. I'm just going to go ahead and pick my own stocks. Right? I get that occasionally from a client or 2 or 3 or so. You know, we don't believe in diversifying. We're going to go and buy McDonald's stock or whatever. Well, look at this slide from 1994. Let's see if that's a good idea. 1994 to 2017. If you had held all stocks, I think this means all U.S. stocks. Oh no. This is across the world, all stocks in the world. So this is global, all right? Global. You had an 8% return. If you just held your global portfolio from 1994 to 2017. Now, what if you said, I'm going to go ahead and pick my own stocks, like our friend Brett Stanley did at Stanley Capital that was down 33% last year. I'm going to go ahead and pick my own stocks because that's what he's doing. And what would have happened had you excluded the top 10% of performers each year? What if the stocks you picked had excluded the top 10% of performers every single year? Your return dropped to 3.6%. Now, what if you had excluded the top 25% of performers every single year? Your return went negative. So if you think it's easy to just go ahead and pick stocks and you're going to not diversify and you're going to figure out how to put together a portfolio that includes, right, that includes the top 10% of performers every single year, good luck. Good luck. And of course, John Bogle, who died yesterday, or maybe it was the day before, really has led the way in helping people understand that you're better off holding your portfolio. All right, we're getting to the end here. I think this is the last slide. So behaviorally, what can we do to hold our portfolios? If we're not going to sell and we're not going to hedge, what do we do? How do we survive bear markets? Well, the first thing we do, of course, is we invest to fit your needs and your risk tolerance. And if your needs have changed or your risk tolerance have changed or you think it has, then let's talk about that. You are never a burden at all on us at New Capital. If you feel like something's changed in the way you're thinking or your needs have changed, then just let us know and we'll do another run through your financial plan and your financial analysis. Happy to do it. So that's the first thing I say. And a number of clients have availed themselves in the fourth quarter and into the beginning of this year. Of course, we contact everybody to have an annual review, but if you're feeling antsy, by all means, lean on your advisor. We structure your portfolio along the dimensions of expected returns. So your portfolios are structured to take advantage of where we know returns come from. They come from the size of companies. They come from companies being value or growth companies. They come from companies being profitable versus less profitable. And in the bond world, returns come from the length of time that the bond is for and the credit quality of the borrower. And that's where returns come from. Returns don't come from whether the United States Congress and the federal government is in shutdown mode or not. We haven't had any, not that I'm not happy at all about the situation, but as a financial advisor, we don't, the research I've seen doesn't show that we know anything about the effect of a federal government shutdown on your portfolio, or of the impeachment of a president. We don't have the ability to firmly associate any of those things with what drives the long-term returns in your portfolio. The long-term returns in your portfolio are going to be driven by the dimensions of returns. And those things we know, and they do not include government shutdowns and impeachments. Diversify you globally. Vanguard, the company that John Bogle founded, came out the other day with a recommendation to their clients that they put 40% of their stock holdings into outside the United States, into international holdings. So we've done that before Vanguard did it. Been doing it for a long time. Vanguard is now upping their recommended allocation to international investments. So we do diversify you globally. We manage expenses, turnover, and taxes. Very important. Anytime we do anything, we want to know if what we're buying is low in expenses, if it's low in turnover and appropriate for taxable accounts. We don't do anything until we understand full tax implications. These are things that we can control. And of course, staying disciplined through market dips and swings, which is what a lot of this talk today has been about. One of the questions I meant to ask in the poll and I didn't was, how often do you look at your account balances? Sorry, Catherine, I meant to put that one in, but some people look a lot and some people never look. I hardly ever look. Just for those of you who want to know, I hardly ever look at my account balances. Maybe once a year, maybe twice a year, maybe. Because I'm invested for the long term and I'm looking to see where I've come 10 years from now, not tomorrow or next week or whatnot. And so if bear markets are very difficult times for you to sit on every single movement in your portfolio. And there's a very strong correlation between your happiness, and not looking at your money every single minute, especially during a bear market. But I would recommend even during a bull market that you not look at your money all the time. It can be tempting, but having some balance, wherever that place of balance for you is going to be the right answer. It doesn't mean that we don't look at performance reports and we don't review that together and we don't make adjustments, but just to look I think can be problematic. And I would encourage everybody to avoid that. Lean on your advisor. We are here. You are never in imposition, whether you want to call or email or come in. We are happy to have you, and I'm happy to hear from you at any time, however you're feeling. Warren Buffett has a very famous saying, be fearful when others are greedy and greedy when others are fearful. And I have trained myself to do this. I was buying securities at the end of December. Our family was in Colorado, and there were a couple days there where I said, I'll meet you up on lift 13. I've got to buy some securities right now. I like the prices. And so you can train yourself to be fearful when others are greedy. When everybody's going gaga over investments and stocks, that's a time to say, whoa. And when everybody else is running for the hills, that's generally a good time to be purchasing investments for the future, because the future expected returns, by definition of securities, go up when the prices go down. In bear markets, it's very important to stay with your health routine, whatever it is, to be healthy, to be mindful, and to be gracious, to have gratitude. So if you've got a $1.2 million portfolio and it goes to $1 million because the market fell 20%, which, as you now know, can happen in any given year, try to look at it and say, I have gratitude that I've got $1 million. I'm one of the lucky people in the world, given the amounts of extreme poverty that there are in many, many places. So these types of affirmations and maintaining your physical health and not looking too much at your money and allowing the bear market to work itself through and to have a positive outlook, these are all very, very important things to being able to survive and even thrive in the bear market. And then lastly, looking beyond the headlines, because as we know, the news comes at us through our phones now, through pads, comes at us all sorts of different ways. And very often the news is deceiving about it's not that the news is intentionally trying to deceive us, it's that it's trying to draw your attention to things that it believes to be important and will cause you to continue to stick with the story so that they can sell advertising. That's how the news business makes its money. And so very often the real story of what's going on lies beyond the headlines. And we try to bring you all that information as much as possible, and are now doing it through the New Capital Journal. Hopefully you all are enjoying getting that. We'll continue to bring you information through the journal. So, reliable information. That does it for my presentation. It's great to be with you today. Thank you so much for taking time out of your day to join us for this call. Hopefully the information that I threw out to you today is helpful and helps steady you and helps put it in perspective when markets head down. I don't know when our next webinar will be, but we will be sure to let you know, and I will look forward to it, and I will look forward to seeing any of you in the office or emailing or calling. And as I said, if there's anything you need whatsoever, please let us know. We're delighted to have you as clients and delighted to help you, and have a super rest of your day. Take care, everybody.